Metropolis Healthcare that reported numbers. If you see in terms of their profitability, a 31% jump is what we've seen. They've actually met street estimates, and the stock is also nearly trading at the day's highest levels as we speak. In fact, let's connect with Mr. Surendran Chemmenkotil, the CEO at Metropolis Healthcare. Surendran, good morning and welcome to the show.
Good morning, Ira. Good morning to you and your viewers.
Thank you. Firstly, congratulations on the strong set of numbers that we've seen. Overall, if you have to look at the key drivers, B2C revenue, the expansion that you've seen into the tier 3 cities, and your average revenue per patient has gone up. Is this a trend that we're expected to see going ahead, or is this going to be a one-off? Because usually the second quarter is always a strong quarter.
Yeah, thank you for asking that. In fact, we have been building these portfolios over a period of time now, both the True Health as well as the specialty portfolios, which really get into the better realization. So that's getting built over a period of time, and we will be able to see this going and getting stronger as in the coming quarters. And our tier 3 expansion is a journey that we started maybe about 18 months back, and we are currently in about 700 towns. In the next 12 to 18 months, you will be able to see us in almost 1,000 towns. So that's also a very strong, strategy that we have around, geographical expansion. And of course, our core markets, the B2C segments continue to do well. And the combination of these three, our performance has been very consistent in line with the guidance we have been giving all the time this year.
Right. So, that you're talking about the guidance as well, it's always in that 13 to 15% in terms of revenue and a 25 to 26% in terms of margins. Now, with your specialty actually doing well, True Health segment contribution also increasing, are we expected to see an upward revision in terms of where the guidance goes as well from here on, if not for FY25, at least for 26, 27?
At this stage, it's very difficult for me to, make a comment on that, because there is also one segment that we are a little bit defocusing, which is our institutional business and the government business, because we wanted to do, businesses which are reasonably good in terms of margins, and easy to do. So there's a little bit of defocus on that segment. So a combination of all these three things put together, at 13 to 15% looks to be the right guidance that I can provide at this point of time.
Okay. So how will the revenue mix shift, taking into consideration the areas that you're going to defocus?
So we have almost now 56% of our revenues coming from B2C. That is going to get better. We are planning to take the B2C revenue to almost 60% kind of a level in the coming quarters. And our B2B is about 34-35%. That also we will get it better, because if you have seen the last 2 quarters, we have done very well on the B2B segment. We are at 13% plus kind of a growth, and that segment will also get better. And our institutional business, which is about 10% when we started this year, has come down to 8%, and this may further go down in the next couple of quarters. So we will see larger part of the revenue is being contributed between B2C and B2B only.
Okay, so my one question, Surendran, that comes up over here is the margin front, right? 25 to 26% is your margin guidance. Now, if your B2C is something which is expected to improve, how are you seeing an impact on the margin front? Because, we have seen competition, they've clearly come out and said that they are not expected to take price hikes. And there are no plans further as well. Plus, you have hospitals that are entering the diagnostic space as well. So how are you expecting this combination to play out for a company like yours? And what's your plan on the pricing front?
In fact, you asked me 3 questions, so let me respond to all the 3 questions separately. So B2C definitely is going to be one of the growth engines, and in our core markets, we will press the pedal on the B2C big time. So that B2C definitely is a better margin business. So B2C is going to help us in terms of improving the margin. But please remember, at the same time, we are setting up new labs and new centers across the country. We started a journey of setting up 90 labs in 30 months. Now we are on course. By the end of this year, those 90 labs would have been delivered. And first couple of years, when you set up a new lab, there's always a little bit of erosion in the margins, because by the time a lab gets into getting a positive EBITDA, it normally takes anything between 24 to 30 months. So the EBITDA erosion because of the new infrastructure addition may continue for a couple of more years. That's one of the reasons why, a little bit of margin improvement through the B2C will get offset there. So that's my answer to your first question. Second answer to your question on price increase. See, we are taking a price increase in January, early January this year. And in the industry, normally a price increase happens in every 2 years. So I'm not seeing an immediate opportunity for us to take the prices up. So maybe another 3-4 quarters, we may have to wait and we'll have to see what happens in the industry, and the industry permits us to take a price increase, and we will just attempt to do that. That's my answer to your second question. And B2, the hospitals entering into the segment, yes, last 3-4 quarters, we are seeing the big hospital chain entering into the diagnostic business. But this is predominantly concentrated only one or two cities like Delhi and Hyderabad, etc., where the big chains have got into the diagnostic business. But then, what, these industries, the hospital industry will always have a dilemma, because they operate on X price inside the hospital, but outside the hospital they have to operate, maybe 50% or less than that kind of a price in the diagnostic centers that they have. So they'll always have this dilemma, and will create some amount of dissonance amongst their customers. So we are not finding anything new in that segment, anything particularly impacting our business. But of course, that will be another competition that you need to live with, and that's fine for us, yeah.
So in all, what you're trying to say is, in spite of the B2C segment being a margin accretive business, you'll not see a major positive impact taking into consideration your expansion plans. And secondly, that continues to remain in the 25 to 26%. But overall, if you have to look at FY26 or 27, what is that one factor that you will expect investors to watch out for?
See, like I said, the high level of lab expansion will be over by the end of this year. So next year, you will see that you'll maybe only finding some 7-8 labs which is coming up, because we have a 1,000 town strategy. So we'll only have labs which will be enough for us to service this 1,000 towns. So we will set up the labs for 1,000 towns, and we will start accelerating, the overall volumes during this in these 1,000 towns. So that's going to fuel the growth for us. And of course, investor can maybe look up to 2 or 3 things. One, of course, our geography expansion and volume expansion from the new geographies. And secondly, the overall realization, getting better as and when the true health and the specialty contribution gets better, the realization get better. And as the lab expansion is going to be over, and maybe next 1 or 2 years, the EBITDA erosion from the additional lab expansion will come down, and then margins will start looking better as you go forward.
Very lastly, with regards to M&As, that has been on your radar from quite some time now. Anything that you would be wanting to 100% do in FY25 itself? We just have a couple of months remaining.
Well, I think inorganic expansion is definitely part of our strategy for this year. We are in active discussion with some of the assets, and we have been progressing on our discussions positively. And like we said in the past, there are 2 or 3 criteria for us to look at the acquisition. One is, if the target is in our non-core areas, that's one of the opportunity that we are looking at. For example, geographies like north or east, will definitely look at assets for us to expand the geography. And second one is, of course, if I can get some of the assets which will help us to increase my capabilities on testing with new areas like genomics or oncology or on molecular diagnostic, I'll definitely look at those kind of assets. And lastly, of course, if you get some assets which are currently distressed, but has got the potential to get better using Metropolis, management and overall focus by us. So these are 3 kinds of assets that we are looking at. We are in active discussions. We are in some of the assets, we are in advanced stages of discussion. Well, this is something which is 2-party. It's not only one party can decide the speed of this whole acquisition process. So we are in discussion. We hope to see something coming up sooner than later.
Absolutely. I think the street will be eyeing the same as well. Thank you, Surendran, so much for joining us on the show. So that's the management of Metropolis, with a lot of takes for the future as well.